Sam, thank you so much for your time and congratulations on the job.
Welcome.
Let's start from here. You take over at a very instrumental time. Phase 1 of the project has been completed, 221 units. I'm curious about the offtake because this market has been struggling with the offtake side of the business. Could you give us some detail into this?
Okay. So at the moment we are 60% pre-sold, which is a good performance given that we launched this project right in the middle of COVID in August 2020. The last 2 years, people have held different views on whether to deploy capital, their own savings or not. And I suppose the safest thing was to hold their capital either in unit trust or in savings accounts, but now we are seeing people move back to investment. So I think a 60% performance is okay at the moment.
You are now in an entity which is backed by two very liquid and significant institutions. Going forward, your agenda, will your capital be largely internally sourced, or do you have plans, especially given your experience with the Centum REIT, to be able to go to market and raise capital?
I think if you look at a typical capital structure of a real estate project, number one, you have the land equity, then you have a cash equity component, and then if you're developing homes, then you'll have a component that's made up of deposits collected from customers. So a typical capital stack would have that, and lastly, debt. So that will be a typical capital structure. I don't think our project will be different. The only qualification I would put there is to say on the land equity side, outside of the land we currently own, we want to be capital light, meaning that we'll be seeking third-party partners to whom we can do joint developments with, and therefore they contribute land equity to the project. We do have committed cash equity. You're right in saying that we do have significant committed cash equity. I think the background for our investors is such that then we have access to very deep debt markets outside of our of Kenya, and that's a significant advantage from our perspective. Would we go to market? I suppose to the extent then that you are raising debt, albeit from banks or other financial institutions, not just in Kenya, to that extent, yes. Do we see ourselves going to the capital market soon to raise any capital? There are no immediate plans for that.
This market is significantly rental driven in terms of the appetite. And when I look at the structuring of Mi Vida, it looks to me like you potentially could be facing what I'd call a market mismatch cautiously. Is there any plan to address this issue of the rental skew of the market?
You raise an interesting point because you have an interesting dynamic in this market. On one side, the rental demand, the demand on the rental side is very deep, significantly undersupplied. And the estimate there is almost 2 million units. You need to be supplying more than 200,000 units per year for you to meet that, the current demand. On the other side, you have developers such as ourselves with what I would call impatient capital. You want capital velocity that's high. Maximum 3 years deploy, exit. So the question has always been then, how do you match those two? How do you match that very deep rental demand and this impatient capital? What we've seen in this market, especially the last 2 or so years, we are having institutional investors who are now raising income funds to whom people can exit, to whom developers can exit. And I think that's a very interesting dynamic. It hasn't developed as well previously. I think what we've seen closest to that is the TPS schemes that the most statutory bodies have successfully implemented. I see that as a significant potential now as the market becomes more institutionalized, as the capital markets develop. So just that capacity to tap into the capital market somewhat, either through private capital or the open capital market.
Okay. Yeah. In your debut video, you did mention that you potentially want to work with other institutional investors. Please give us more detail on this.
Okay. And it first back to the question that you just asked, that we have seen now in this market several institutional investors make pronouncements or actually develop some sort of income fund. These income funds are targeting to acquire units from developers and hold them for rent. And I think there is potential there then to partner with such institutional investors so that then you have a seamless development offtake mechanism that addresses that demand that you're talking about, but doesn't force developers then to build and hold to rent, which capital they don't have.
And
Pipeline in terms of that first phase?
The project's now beyond phase one.
Okay. Yes, so we go to market on phase 2 from August. We then should give it a 6-month pre-sale period. So we should start construction activities later in the year or early next year. There is also planned phase 3. So the next phase will be 300 units for phase 2. There is a planned phase 3, probably similar 300. That is just a Garden City site. Within Garden City, after the first 3 phases, we still have opportunity to develop more mid-market homes. But besides that, you see, we must be a very demand-driven business. So we are looking at sites outside of Garden City in areas we consider the demand for affordable housing to be deep. Yes.
Still on the issue of your capital, I'd imagine a lot of the financing you have is dollar denominated. And when you look at the offtake being in KES, and the shilling has been roiled just like any other emerging market currency, how does this then impact your returns and what you're giving back to your investors?
I think typically when you are investing in KES, the demand has always been that your IRR must be significantly above, say, a 20% hurdle rate to be able to accommodate those kind of dynamics, to accommodate the risks, the market risks, but also the financial risks such as capital depreciation, especially when you're getting dollar-denominated equity. You are right, we've seen significant volatility, especially the last 2 years on the Kenya shillings. You know, before that, the Kenya shilling was relatively very stable, so it wasn't a problem. I suppose the pressure now is on us who are receiving the capital to even see how much more can you enhance that equity IRR on a project to be able to match the investor return expectations. Interesting, so if you look at a typical project, you'll have a project IRR, which just, you know, it doesn't at that point differentiate the source of capital. That's just at the project level. But the more debt then you're putting into a project, and the less the equity, the more than the equity IRR. And I suppose then the question there is, how do I make my project cost as low as possible? So I'm reducing the overall investment, that's number one. But what creative debt equity mix structures does one apply to sustain that equity expectation, the equity return expectations of the investors?
So we are in a market which is experiencing cost escalation on a day-to-day basis. And what we'd like to know is, how does this impact your posturing as an entity, especially as you take over, and how do you intend to keep a tight lead on the cost side of the business?
It's a daily headache for us. I think if you look at the total cost of a project, you have land as a cost, anywhere 15 to 20% of the overall project cost. You have the professional services. Then, of course, now you have the main building cost, what the main contractor will charge, including the materials, and therefore, and the finance costs. I think you have to look at each of the cost components and say, what can one do at each level to still keep your cost low? Typically, we look at cost on the gross built-up area. So, you know, a typical cost quotation will be X Kenya shillings per square meter of the gross built-up area. I think it's important to look at the cost, that cost on the basis of the sellable area. What is your total construction cost per each, you know, square meter of sellable area? And that question then speaks to efficiency. That the more efficient your design is in terms of the quantum of the sellable area over the total gross built-up area, the more then the cost per sellable area will reduce, and hence the higher the profitability. So the first thing there is the design. You have to be very, very efficient in your design, especially for the high rise and the more affordable product that you're building. That's one. On the land side, I think the opportunity today is that you can have a good entry price on land, especially if you're an institutional investor. You have a lot of third-party land owners who are looking for people they can co-develop with, but they are credible people. And you see, this market has previously been characterized, you know, has been a very fragmented market. You haven't had a lot of institutional players. So it's not that we have many of us that these landowners could partner with, and that gives you an opportunity then to negotiate better from a land cost perspective. On the construction cost, scale gives you certain advantages. You can then leverage on that skills to source better. Because when it comes to sourcing, if you're just sourcing locally, you realize between the manufacturer, say in China or Turkey or Egypt, and yourselves, is that value chain has so many players, each of whom is marking up on their cost for profit, you, the developer, then ends up the last party or the last participant on that value chain, and therefore you are paying all these people their markup. Scale allows you to cut that value chain and directly engage with the manufacturer, which then is what we'll be looking to do, is what we are doing at the moment. And that can have significant cost advantage, just given the realities of where costs are moving. Equally, one, I suppose, has to have very strategic relationships in this industry that, again, given the quantum of work you are giving either the professionals or the contractors, it allows you again to have some significant negotiation power as to the costs.
In the recent past, we've seen developers structuring REITs, that's real estate investment trusts, to try and address the liquidity challenges that properties are facing and their return to investors as well. Is this something that could be on the table for you as you take up the new role, probably structuring a REIT and going to market with it?
My sense is that this is where the market will naturally grow. And I know there have been views previously about the performance of the listed REITs, but my sense is it just reflects the state of development or sophistication or lack of it in the market presently, but points to where I would expect the Kenyan market to go with time. If you look at the more advanced market that you can compare with, it's South Africa. The REITs market there is, it's very deep, it's significantly developed. So I suppose the expectation and the projection that is the next phase of institutionalization of real estate as an asset class, it's not far-fetched to say that that's where I would expect that market to go. The Econ REIT performed very well. There have been 2 private funds now raised, 2 private income funds to acquire assets and manage them. And what these movers then demonstrate is that there is an opportunity from that investment. So to your question then, do we see ourselves going there? In one way or the other, yes. Either by partnering with similar institutional investors who manage those kind of funds, or why not us looking to do our own fund. I suppose the advantage we have today is that we are backed by not just the 2 investors, but ACT as a fundraiser. So that's an advantage that we enjoy in this market and probably broadly in the African context.
How much is the government's affordable housing pillar of the Big Four agenda a driver of your business, and do you see a potential continuity risk when we are transitioning from one administration to the next?
I would say it's significant. If you really think about affordable housing, it's not just a Kenyan issue. The entire each government in sub-Saharan Africa, one way or the other, talks of affordable housing being a key policy issue. So I wasn't surprised, when the president announced it. I suppose he just picked it out of a broader thinking of infrastructure, because to the point, to the discussion you were having earlier, today there is a major need for affordable housing because you have a significant rental demand for it. And you see that as you drive around Nairobi. You see just this sprawl of unplanned flats. My sense is that sprawl shows the response of the market to what is a significant need and a supply deficit. So I think it's rightly identified. If I look at the manifestos of the people who are now looking to form the next government, I think both of them still recognize the need to continually supply affordable housing. Urbanization is increasing. And I suppose in Kenya we have an interesting situation that it's not just urbanization today in Nairobi and Mombasa and Kisumu, the major cities, but with the devolution then you formed new economic centers at the county level. So you have the second tier of major towns who, if you drive around, you start to notice the same sprawl of flats because they are urbanizing rapidly, but you still don't have that institutional supply of quality homes that addresses that market need. So it is rightly a national agenda. And then I suppose it's now up to us, people who are able to do that at scale, to come and respond to it. It is also a big investment opportunity for people chasing a return because the demand is there.